Welcome back to the Williams Real Estate Channel. Today we are running through the macro market update for June 2026. We use the 18-year land cycle as our framework to guide us through the market cycle so we know when to buy, when to stop buying, when to renovate, develop, and even sell out of as the overall macro market plays out. We are on the blue marker coming in now to the final stage of the fourth and final quarter when we're due. Now, anytime, I guess, from now till 28, something will happen in the market that will panic, and then we'll see widespread selling. Stock markets typically get hammered in the later stage of the cycle, just like what we saw from October 2007 to 2011. Globally, stock markets went backwards 40–50%. The likes of Brisbane, Perth, Adelaide, Darwin, and their respective regions will all top over, roll into their downturns, and then over time, the demand will continue to swing back into Sydney, Melbourne, and we'll see Sydney and Melbourne lead again, just like what we saw from 2007, 8, and on throughout the next growth cycle. So there's always a market to buy into. There's always a deal to get. Money keeps flowing. Transactions will always keep transacting in residential real estate. There's 500 to 600,000 transactions every year in Australia. It won't just stop all of a sudden. It just, the demand's currently going into Brisbane, Perth, Adelaide, Darwin, and their respective regions over the coming years. That will continue to swing out of those markets and back into Sydney, Melbourne, where they've been stagnant for some time now, which is where we're mainly focusing on today, Sydney, Melbourne, and starting and looking at the likes of regional Victoria and New South Wales as we buy the future growth. You don't buy what has been in recent years. So we like to get into markets once we can see solid stagnation, a good 8, 9, 10 years of stagnant growth, when stage is set for the coming growth cycles where the price point's low relative to build costs and there's strong yields between 6 to 8%. Purpose for today is to run through some macro data points that we like to track so we can understand where we are sitting and how we see the cycle continue to keep playing out as it has for over 200 years. Gross domestic product, GDP, continues to be more or less pretty subdued, sluggish. There hasn't been any data since out from March 26, so something we keep a close eye on. If it starts to trend down and dip, then we know that we'll be in the next downturn. The Australian unemployment rate continues to trend up. It's up to 4.4%, seasonally adjusted as of May 26. Data is low still relative, but the trend is what we watch. Once it starts to trend up, it'll continue to gain momentum, and eventually businesses will start laying off people quite aggressively, and that's when we'll see a spike like what we saw throughout the COVID recession or the GFC or the dot-com bust or the 90s. We'll see another run on high unemployment in the coming years. The Australian inflation rate is also trending up. We had a little bit of a pullback to 4% in the all groups, but is the trim mean is what the RBA keeps a close eye on, which is sitting at 3.6% as of May, which is well above their target of 2 to 3%. And the trend is what we are looking at rather than the actual number. It's what is actually happening, but behind the scenes, it's trending up. So it looks like it's baked in from here. And the only way to get the inflation rate down, which is the key mandate for the RBA over the unemployment rate. So I see a lot of people saying that rate's going to come down now, that the unemployment rate's starting to trend up. The RBA is more focused on the inflation rate, which is still well above their target band. So we saw the RBA hold in June the cash rate at 4.35%, but I suspect there's a couple more rate rises still left in the tank in this cycle, just like what we saw from 2002, 3, 4 up to 2007. This is this final rate hiking session, which we're in the midst of right now. So best to not take on too much debt and overextend yourself because rates are more likely going up. The banks have most recently starting to drop some of their rates to try and drum up some more business as credit applications have been slowing after the May budget, along with higher rates. But I don't suspect the RBA to drop the cash rate anytime soon, not for a good 12, 18 months at least, until we enter the end of cycle and it's clearly evident to the mainstream that we've entered the next downturn come late 27, early 28. That's when the RBA will then panic and realize that they pushed rates too high for too long, like what they did during the mid-cycle slowdown, the COVID 2020, 21. They had rates too low for too long. So here we are again. The US leads the global economy, so that's why we like to keep tabs on them to see how the US is tracking. They've got 2% growth out of Q1 26, no further data since. But what we're watching is if we see a quarter or two of negative growth, that's a clear definition of a recession is 2 quarters back-to-back negative growth. So this is something we keep tabs on, which is still relatively strong in the US. In the background, we have also the unemployment rate steadily rising. It's up to 4.3, still low, but the trend is slowly trending up. So again, like similar to what we're seeing in Australia, we'll continue to see the unemployment rate in the US continue to keep trending up, and gradually it will start to gain momentum and run even harder and higher in the coming years. US inflation rate is up to 4.2%. This is quite high now. And because the US has a target of 2%, so it's well above 2%. They don't have a band of 2 to 3%. So that's an issue for the Federal Reserve, even though Trump wants low rates. Doesn't look like he'll be getting low rates anytime soon, as the new Fed chair vows to reforms, as central bank signals rate hikes are on the horizon. So the new Fed chairman that Trump put in, his intention was to put someone in that would listen to what he says and drops rates. But based on commentary coming from the new Fed chair in recent weeks, it sounds like he is definitely reluctant to dropping rates, and if not even raising rates, as inflation in the US is trending well above their target of 2%. Stock markets continue to hit all-time highs, which is another key indication that we're late in the cycle, even though in the background we've got unemployment rising, inflation's high, rates are going up. The euphoria is still there, pumping the markets up, which is classic setup we see late stage of the cycle. Bitcoin has taken a bit of a hiding. See how Bitcoin goes, whether it's got another leg up. It may well stabilize here and then go for another leg up. And then the real question will be, will Bitcoin and crypto survive the next end of cycle come 28 and on? Who knows? Time will only tell. And in the background, we have the US median sale price for residential property across the US in decline. just like what we saw throughout the GFC, as well as the 90s. House price, land price starts to lose momentum first before then we enter the recession. So it's already happening in the US. It's starting to happen in areas across Australia as well. So over the next couple of years, land price will continue to slow, and then something will panic the markets, and then we'll have high unemployment with high rates. We'll have a tanking stock market. It'll all be doom and gloom, which is the best time to buy. Another chart I like to just keep tabs on is Gann's decade cycle as a framework, years ending in 6. We are in the midst of a year ending in 6. This is more so looking at stocks, the way the market runs for the stock markets. They're having a bit of a breather, and we can expect another leg up from here to mid-late 27, at which point something will break, just like what we saw in October 2007, and down she went. And this here will not happen until a good few years later, as we are in the second half of the 18-year land cycle, when the land-driven downturn is much more severe. So something to keep tabs on as a guide. As always, none of this is financial advice, as we do not know yourselves or your personal situation. Prior to making any investment decision, be sure to seek legal, independent tax advice, financial advice. But if you want help building a long-term sustainable portfolio and being guided through the market cycles, buying individual units, villas, townhouses in metro markets, houses in the regions, and then blocks of apartments, both metro and region, to build out your solid all-weather foundation phase 1 portfolio, and then build into bigger deals like phase 2, blocks of apartments, the best of both worlds, hit us up, shoot Alex an email. We can get on a call, we can discuss your plans and how we could work together and get you a deal and keep building out your long-term portfolio. Until next time, thanks for watching.